High net worth individual is a term used by some segments of the financial services industry to designate persons whose investable assets exceed a given amount. Typically, these individuals are defined as holding financial assets with a value greater than $1 million. However, there are distinct classifications of HNWI, and the exact dividing lines depend on how a bank wishes to segment its market. For example, an investor with less than $1 million but more than $100,000 is considered to be affluent, or perhaps even sub-HNWI. Very HNWI can refer to someone with a net worth of at least $5 million. By 2007, the expansion of HNWI assets led to the creation of a superclass of HNWIs, known as ultra-high net worth individuals, i.e., those with $30 million in liquid financial assets, according to the Capgemini and Merrill Lynch World Wealth Report 2006, and with a disposable income of more than $20 million. At the end of 2015, there were just over 13 million HNWIs in the world. The United States of America had the highest number of HNWIs of any country, whilst London had the most HNWIs among cities, as based on data from the Knight Frank Wealth Report. United States SEC regulations. The U.S. Securities and Exchange Commission requires all SEC-registered investment advisors to periodically file a report known as Form ADV. Among other things, Form ADV requires each investment advisor to state how many of his clients are high net worth individuals. The Form ADV glossary of terms explains that a high net worth individual is an individual with at least $1 million managed by the reporting investment advisor, or whose net worth the investment advisor reasonably believes exceeds $2 million of the Investment Company Act of 1940. The net worth of an individual for SEC purposes may include assets held jointly with his or her spouse. Unlike the definitions used in the financial and banking trade, the SEC's definition of HNWI would include the value of a person's verifiable non-financial assets, such as a primary residence or art collection. Annual World Wealth Report. The World Wealth Report was co-published by Merrill Lynch and Capgemini, previously known as Capgemini Ernst & Young, who worked together since c. 1993, investigating the needs of high net worth individuals in order to successfully serve this market segment. Quote, "The first annual World Wealth Report was published in 1996. The World's Wealth Report defines HNWIs as those who hold at least $1 million in financial assets, and ultra HNWIs as those who hold at least $30 million in financial assets, with both excluding collectibles, consumables, consumer durables and primary residences." The report states that in 2008 there were 8.6 million HNWIs worldwide, a decline of 14.9% from 2007. The total HNWI wealth worldwide totaled $32.8 trillion, a 19.5% decrease from 2007. The ultra HNWIs experienced the greater loss, losing 24.6% in population size and 23.9% in accumulated wealth. The report revised its 2007 projections that HNWI financial wealth would reach $59.1 trillion by 2012 and revised this downward to a 2013 HNWI wealth valued at $48.5 trillion, advancing at an annual rate of 8.1%. The 2013 World Wealth Report was jointly produced by Capgemini and RBC Wealth Management and included, for the first time, the Global HNW Insights Survey produced in collaboration with Scorpio Partnership. The inaugural survey represented one of the largest and most in-depth surveys of high-net-worth individuals ever conducted, surveying more than 4,400 HNWIs across 21 major wealth markets in North America, Latin America, Europe, Asia-Pacific, Middle East, and Africa. Scorpio Partnership have established themselves as a market leader in the supply of HNW insight, having spent over 15 years conducting private client interviews, collecting business intelligence and working with over 100 clients who range from universal banks, domestic retail banks, specialist private banks and fund managers to family offices, high-net-worth clients and regulatory bodies. The partnership is independently owned and managed by Sebastian Dovey and Kath Tillotson and carries out global assignment overseen from its base in London's West End. Capgemini figures. The World Wealth Report is published. Capgemini has estimated the number and combined investable wealth of high-net-worth individuals as follows, using the United States Consumer Price Index inflation calculator. Banking and finance. Most global banks, such as Credit Suisse, Barclays, BNP Paribas, Citibank, Deutsche Bank, HSBC, JP Morgan Chase and others, have a separate business unit with designated teams consisting of client advisors and product specialists exclusively for HNWI. Because of their extreme high net worth and the way their assets were generated, these clients are often considered to have characteristics similar to institutional investors. By 2006, asset managers working for HNW individuals invested more than £300 billion on behalf of their clients. These wealth managers are bankers who in 2006 earned multi-million-pound salaries and owned their own companies and equity funds. In 2006, a list of the 50 top investment bankers was published by the Spears Wealth Management Survey. Retail brands in various sectors, such as Bentley, Maybach, and Rolls-Royce in motoring, actively target HNWI and HNWI to sell the products. In 2006, Rolls-Royce researchers suggested there were 80,000 people in ultra-high net worth category around the world. HNW individuals have, on average, 8 cars and 3 or 4 homes. 3/4 own a jet aircraft and most have a yacht. Academic studies of asset management trends. The Wharton Global Family Alliance white paper was released in 2008 to study the investment strategies of single-family offices in the United States and in Europe. The research was segregated into subgroups representing those with less than $1 billion in assets and those with assets above $1 billion. The study found that U.S. families reported a more aggressive attitude toward investment objectives than their counterparts in Europe. One recommendation of the WGFA study advised the advisors and family officers serving this niche to avoid complexity in the structure of portfolios. The authors cite that the more complex the portfolio and number of holdings, the more difficult the job of performing adequate governance, reporting, and education. The Institute for Private Investors, a peer networking organization for wealthy families and their advisors, suggested a similar theme to its membership in 2008 with a conference themed The Return to Simplicity. Kotak Wealth Management and CRISIL Research published a report on the ultra-high net worth individuals in India titled Top of the Pyramid Report. high-net-worth individuals' taxable portfolios. Since 2009, the Gannon Group has managed wealth exclusively for HNW and UHNW individuals and families at Morgan Stanley's Portfolio Management Group. In his book entitled Investing Strategies for the High-Net-Worth Investor, Maximize Returns on Taxable Portfolios, Gannon Group's executive director Niall Gannon investigated asset management strategies for high-tax bracket investors on taxable portfolios. Gannon advises taxable investors in terms of long-range estate planning decisions and assists them in making more accurate estimates of their expected total portfolio value. He studied the S&P 500 index on an after-tax basis and found the return to be 6.63% after paying taxes at the top prevailing federal tax rate, and a constant average of 6% for state taxes from January 1, 1957, through December 31, 2010. Additional results from Gannon's research found that a portfolio of municipal bonds outperformed the reinvested S&P 500 index in 17% of the rolling 20-year periods since the inception of the index. Gannon rejects the use of historical returns for future asset allocation modeling for high-net-worth investors. He argues that an observation of stock portfolio earnings yields are more indicative of the future return potential of the portfolio when modeled, with the impact of taxation on performance. Liability insurance. High-net-worth individuals have unique risks to the wealth through legal liability and tort law. Therefore, they commonly purchase umbrella insurance policies which further protect them from expensive lawsuits. These umbrella policies are designed in an open-ended way to cover risks which fall through the gaps of other insurance policies. They are also commonly specifically designed to have higher limits for covering lawsuits resulting from expensive vehicle accidents, home accidents, defamation, and fiduciary liability arising from non-profit board volunteering. In the United States, a trade group called the Council for Insuring Private Clients was formed in 2012 to focus on this market. Companies known to focus on the market include Chubb, Ace Limited, and Privilege Underwriters Reciprocal Exchange. As a cheaper alternative, a personal excess policy may be purchased instead, which is not designed to cover the gaps in coverage the way that an umbrella policy does.